Hello dear friends, John AG here, and I need you to stay with me because what I am about to show you is not just another silver update. This is the kind of pressure build that looks quiet on the outside, right up until the moment it explodes. People keep arguing about a number on a screen, but the real story is hiding in plain sight. Physical silver is getting awkward to source in places where money has no patience. And when wealthy money gets impatient, it doesn't post about it, it moves first. Before we dive in, a quick favor. I am running a campaign to push back against copycat channels that recycle other people's work and drown out original research. If you value what I do here, subscribe and drop any comment at all. Type urgenag if you want. That one comment tells the algorithm this is real, and it helps me keep this channel clean. Alright, let's get into it. Yesterday's price action was a mess. Silver got smacked hard, then snapped back. If you were watching intraday, it felt like someone was trying to shake people out with both hands. And here's the part that should make you suspicious. When the paper price swings like that, you would expect physical to be easily available at the cheap level. Yet the reports from the physical side are telling the opposite story. Let me start with Switzerland, because Switzerland is not a random country in this story. Switzerland is where family offices park capital, where private clients move quietly, and where counterparty risk is not a theory, it's a daily calculation. A contact there described it plainly. There's a visible shortage. Visible, as in, you can walk into major dealers and see empty slots where silver products should be. One of the biggest dealers in Switzerland reportedly had zero silver inventory for periods of time. Not low stock, not backorder, just none. Now silver does come in from sellers. People always sell. But the moment the metal hits the dealer's hands, it's taken by the next buyer. It's like water poured on hot sand. There's no pool. It just disappears. Gold isn't immune either. Small bars and coins have been getting cleared out first, leaving mostly larger bars behind, 250-gram bars, 500-gram bars, and kilo bars. That pattern tells you something about buyer behavior. Smaller units are grabbed when many buyers are trying to secure something quickly. Big bars linger slightly longer because fewer people can write that check casually. Now you might say, okay, that's Switzerland, so let me widen the lens. In the UK, similar shortages have been popping up in popular 1-ounce silver products. Sites show product pages, but the specific coins people want are suddenly out of stock for days at a time. And in the US, if you look at major online dealers, you'll notice something strange. The paper spot may print one number, but the actual price for a 1-ounce government coin can land far above that, sometimes by a shocking amount. So you get this weird split reality. Futures say one thing, but your checkout cart says another. That split is not a small detail. That's the market giving you a clue about stress. Now let's talk about volatility and why it's happening. Let me tell you what the chart looked like to me in real time. Where my cursor would be on the screen, you could see silver sliding, and then bang, an acceleration lower that felt less like normal selling and more like forced selling. At one point, prices were printing in the mid-60s before bouncing back toward the low 70 seconds. That kind of move in a quiet market is not quiet at all. Now here is the trick. When you see a plunge like that, your brain screams discount. But the physical market doesn't behave like a Black Friday sale. If you call a dealer and say, great, silver is cheaper, sell me 10 ounces, the dealer doesn't magically say, sure, I'll sell at spot. The dealer says, do I have it? If I have it, can I replace it? If I sell it now and the price spikes overnight, am I stuck? And that's why the premiums can stay high even when the chart drops. This is also why a lot of smart money is allergic to paper promises right now. It's not because they hate trading, it's because in a stress event, what matters is settlement and access, not the sticker price. Let me give you a concrete example. In the UK, you might see spot around the mid-£50 range per ounce equivalent, but a popular 1-ounce coin can cost you far more. Then you add VAT and the effective price jumps again. In the US, a 1-ounce government-minted coin can list in the high 80 seconds or near $90, even when spot is much lower. So if you're the average person, you can't even participate at the paper price. You are forced to pay the street price. And if you're a serious buyer, someone buying size, you often bypass the retail shelf entirely and go after larger bars, direct sourcing, or vault programs. That is why Switzerland matters. It's a place where those serious buyers live. Now, some viewers asked me, John, does this remind you of 2008? In one sense, yes. Crises dump paper for cash, physical tightens, delays, premiums jump. So don't let the chart hypnotize you. Always ask, what is the settlement reality? Now let's talk about the rumors swirling around who caused the volatility. There have been stories about large players shorting heavily on Asian exchanges, trying to profit from spreads between markets, expecting those spreads to narrow. If that kind of trade goes wrong, it can create violent moves because positions get unwound quickly and leverage amplifies the pain. But I want you to notice something. Whatever game speculators play, they do not create a shortage in a Swiss shop window. Speculators can move paper, they cannot tell a port bars into inventory. So I use these rumors as context, not as the core explanation. The core explanation is demand for physical control rising while deliverable pools are thinning. Now I'm going to walk you through the delivery picture in even simpler language. Imagine there is a warehouse with two rooms. Room A is deliverable right now. Room B is metal that meets the standards, but it belongs to someone else. When contracts come due, the market can easily satisfy delivery as long as Room A is well stocked. But if Room A keeps shrinking, the market has to persuade people in Room B to move their metal into Room A, and persuasion usually takes one of two forms: higher price or higher perceived risk. If people in Room B are holding because they don't trust the system, they may not be persuaded easily, so March becomes a test. Can the system keep Room A stocked enough to meet delivery calls without a drama event? Now, here are the numbers, in plain terms, without getting lost in decimals. In October, registered inventory was comfortably above 150 million ounces. As we moved into the new year, that number fell toward the low 100 seconds. At the same time, open interest for big contract months remained very large, hundreds of millions of ounces of potential claims. And yes, not all open interest takes delivery, a lot rolls or closes. But recently, the portion taking delivery has been unusually high, especially in earlier months that normally don't attract that kind of delivery intensity. That is the key, because if buyers are pulling deliveries forward into January and February, it suggests they want metal sooner rather than later. Now imagine the psychological effect. If you're sitting on a March contract and you see a flood of deliveries in February, you start thinking, what if March gets tight? And then you do the rational thing. You either roll into an earlier month, or you demand delivery early, or you arrange alternative sourcing. Each of those actions adds pressure. Now there's also a point people miss: eligible inventory falling matters. If eligible is falling too, it suggests metal is leaving the vault ecosystem, not just being relabeled. That can happen when big holders choose to remove bars and store them elsewhere, or move them into private vaults, or ship them to meet demand in other regions. Whatever the reason, fewer bars in the system means less flexibility, and less flexibility means more sensitivity to delivery demand. Now this is where the exchanges escape. Hatches come back in. Technically, the system can change rules, raise margins again, offer incentives to settle in cash, or use other mechanisms to reduce delivery pressure. But every time those mechanisms are used, the market learns a lesson. Paper claims come with policy risk, and once that lesson sinks in, more people want physical. So the escape hatch can create the next wave of demand, even if it solves today's problem. That's why these events can become self-reinforcing. Now let me address the people who say, John, why should I care? I'm not taking delivery on COMEX. You should care because the futures market influences pricing for the entire ecosystem. If delivery stress forces price discovery, it can reprice everything. Coins, bars, ETFs, mining equities, even industrial contracts, and it can do it quickly. Now let's connect the silver story to gold again, because gold is the policy metal. When you see unusual options positioning, far-out calls gaining interest, it can hint that someone expects a large, fast repricing event. Sometimes that event is a currency event. Sometimes it's a liquidity event. Sometimes it's a policy announcement. Sometimes it's simply fear. But in all cases, when gold volatility rises, silver often becomes a rocket with a loose steering wheel. So I keep an eye on both. Now the macro backdrop matters too. We've seen stress in mega cap tech, and part of that stress is confidence. When investors start questioning how real the demand is, when they start seeing vendor financing and circular money flows, the narrative changes from growth to fragility. At the same time, crypto markets have been swinging hard. When crypto dumps, it can force liquidations in other assets because people use the same collateral pools. That's another reason metals can get sold in the paper market, even when the fundamental case is strengthening. But remember, forced selling is temporary. Scarcity, if real, is persistent. Now, if you're wondering where this goes, here's my base case. We likely see more turbulence and more attempts to shake out leverage. We likely see headlines that try to confuse you. And we likely see physical remain stubbornly bid in certain regions, even when paper tries to calm everyone down. And then, at some point, you get a week where the market asks a different question. Can we source enough metal for delivery? That is the week where silver behaves differently. Now I want to make this interactive because you are my eyes around the world. In the comments, tell me your country and tell me two things. 1. Can you buy a popular 1-ounce silver coin right now without waiting? 2. What premium are you seeing over spot? If enough of you respond, we'll have a real-time map of the physical market. No theory, just reality. And yes, I read those comments and I use them. Now let me also give you a calm checklist because I don't want you to feel overwhelmed. If you're a physical buyer, you care about availability, premium, delivery time, authenticity, and storage. If you're a paper trader, you care about margin rules, volatility, position sizing, and stop discipline. If you're a minor investor, you care about costs, cash flow, jurisdiction risk, and balance sheet strength. Different tools, different risks, different time horizons. The only wrong move is mixing the lanes without understanding the risks. Now, one more cliffhanger, because this is the part people forget. Silver is not just a money metal, it's an industrial metal. When the economy slows, industrial demand can soften. But when strategic competition heats up, defense and technology demand can harden. So the demand picture can be complicated. That's why the physical tightness signal from wealthy buyers is so powerful. It is not dependent on industrial cycles, it's dependent on trust. And trust can shift faster than any industrial forecast. So as we move toward March, I'm watching the trust signal. I'm watching whether more big buyers insist on possession. And I'm watching whether the market tries to hide stress with paper tricks. Because if the paper physical gap widens, the gap eventually gets closed, either by physical easing or by price rising. And when price rises quickly, the headlines will act surprised. Don't be surprised. Be prepared. When silver gets extremely volatile, exchanges often raise margin requirements. That is not a moral judgment. It's a mechanical response. If you want to play this game, bring more collateral. And what does that do? It punishes leverage. If you're trading with borrowed money, a margin hike forces you to add cash or close positions. If you can't add cash, you sell fast. That's how you can see violent drops in the paper price. Even when physical demand is strong, weak hands get forced out and the chart looks ugly. Meanwhile, on the physical side, buyers don't care about your liquidation, they care about ounces. This is exactly why the futures market can wag the dog for a while, but it can't do it forever. Now I want to plant a cliffhanger right here because it matters for everything that follows. The March contract is sitting like a loaded spring and the inventory cushion has been shrinking at the same time. Hold that image in your mind, a spring tightening while people tug harder. Now one more input from the ground that matters. Big money appears to be moving away from counterparty risk. A market contact told me something consistent with what I'm hearing elsewhere. Family offices and large pools of capital are increasingly asking for physical gold and silver, not paper claims. They want no middleman, they want no promises, they want control. At the same time, liquidity in certain private markets has been drying up. Investors who want out of private equity or private credit are sometimes seeing bids that feel painful, like selling $1 for a fraction just to get liquid. And when that kind of liquidity stress spreads, it changes behavior. People stop chasing returns and start chasing certainty. This is where physical metals re-enter the conversation. Now let me take you into the delivery data because this is where March starts to glow. When you look at COMEX delivery notices month by month, the recent trend has been dramatic. More contracts are being converted into actual delivery requests compared with prior periods. That's not just more trading, that's more people saying, deliver the metal. Every silver contract is tied to a fixed amount of ounces. So when deliveries surge, it means the market is being asked to source real bars, not just settle cash. Now I'm going to describe a chart the way I would if you were sitting beside me. Imagine a bar chart with months along the bottom and ounces on the side. The bars for the latest year are repeatedly taller than the bars for the previous year. Not once, not twice, month after month. And when you add the totals, you see a year-over-year jump that is hard to ignore. Now zoom in on the most recent months. January 2026 was not a small uptick, it was a jump that makes you blink. February, and we're still early in the month, has already seen delivery activity that rivals what used to be a full month number. But the most important signal isn't only the absolute ounces, it's the percentage of open interest that is being taken to delivery. Open interest is the number of contracts that are open, positions not yet closed. Normally, a lot of that open interest rolls, closes, or nets out, but when an unusually large portion gets called for delivery, it tells you participants are not treating the contract like a casino chip, they're treating it like a claim ticket. Now March is the heavy month. March is not an odd little side month. It's a major contract month. It is the month where delivery demand can naturally swell because it is the front contract many institutions use. So what happens if participants start getting nervous about March? They pull demand forward. They say, I don't want to be waiting at the end of the line in March. Let me take delivery earlier, even if it's inconvenient. And that behavior, if it spreads, can create an early squeeze. Here's where it gets uncomfortable. Registered silver, the category tagged as deliverable, has been falling hard. Let me simplify the category so nobody gets lost. Registered bars that are in the right form and are officially available to be delivered against contracts eligible. Bars that meet the size and purity requirements, but they belong to someone. They are sitting in the vault, but they are not automatically on the table for delivery unless the owner chooses to move them into registered. Eligible is like a parking lot full of cars. Registered is the set of cars with keys already in the ignition, ready to drive away. When registered shrinks, the ready-to-deliver pool shrinks. And recently, that registered pool has been dropping from the mid-hundreds of millions of ounces down toward the low hundreds, and it's been doing it quickly. Eligible has been falling too, which matters because it hints that metal is leaving the system, not just changing labels. So you have potential March demand sitting large while deliverable supply trends lower. That doesn't guarantee a catastrophe, but it does guarantee tension. Now, someone will always say they can cash settle. Yes, mechanically they can, but here's the psychological and market reality. When buyers are demanding physical because they distrust paper, cash settlement is not a substitute. It is an admission, and an admission in a credibility-based market is expensive. Now, the other layer people keep bringing up is the China spread story. There have been rumors about a large speculator leaning short on a Chinese exchange, allegedly attempting to play a spread between markets, expecting the gap to close. Whether that's true or not, the important idea is this. When spreads between major pricing centers become volatile, it creates incentive games, and those games add fuel to the fire. But even if paper games are causing the short-term chaos, the physical message from Switzerland and other places remains. Real metal is not behaving like abundant supply. Now let me add a practical detail because I want you to imagine the experience of a real buyer. In the UK, if the spot price is printed at a certain level, you might still pay dramatically more for a 1-ounce coin. Then you add taxes like VAT, and the all-in price becomes even more detached from spot. In the US, premiums can go wild, especially on popular sovereign coins. So the question becomes, what is the true market price? Is it the number on a screen, or is it the number you have to pay to get metal into your possession? That's why I keep saying, watch the real-world price, not just the chart price. Now, I promised you high retention, so here's another cliffhanger. The next part is not about silver, but it may explain why gold options traders are placing bets that look insane, unless you understand what they're really betting on. In the gold options market, far-out strike calls, numbers that sound almost comedic, have seen notable open interest. A strike like $15,000 on gold, or even $20,000, sounds crazy if you imagine it as a prediction, but options aren't always a prediction tool, they're often a volatility tool. If you can buy a cheap lottery ticket and volatility explodes, the value of that option can jump long before the underlying ever reaches the strike. So when you see unusual interest in far-out calls, it can be a signal that someone expects a shock. Policy, currency, liquidity, something. Now tie that back to silver. Silver is the more volatile sibling. If gold sneezes, silver sometimes flips the table. So if the macro environment produces a volatility shock, silver could experience a repricing event that makes the paper-physical gap impossible to ignore. Now let's talk about revaluation, because this concept has been drifting around quietly for years, and it tends to surface whenever debt math becomes uncomfortable. If a government holds gold at an old accounting value, it can, in theory, revalue that gold higher and create balance sheet room. There are mechanisms discussed in policy circles, gold certificates, accounting adjustments, transactions between the Treasury and the central bank that can create funding space without issuing standard debt the way people normally measure it. I'm not saying this is the plan, I'm saying it's a lever that exists, and when people in high places start casually mentioning gold-backed structures or commodity backing, you should listen, and we've been hearing more of that kind of language lately, not less. Now, because this topic always attracts rumors, there are also claims floating around about whether all official gold is exactly where people think it is. Some of those stories are sensational, some are recycled, some are political theater. The point isn't to get lost in the rumor. The point is to notice that the rumor exists at all, because rumor is a sign of trust erosion. When trust erodes, physical ownership becomes more attractive. Now zoom out again to liquidity. We've seen major risk assets sell off at the same time: tech wobbling, crypto falling, metal slapped in the paper market. That's the raise cash phase. People sell what they can, not what they want, but that phase doesn't last forever. Sooner or later, money asks, where do I hide from dilution? And that's why commodities and hard assets often get a second wave of attention after a cash dash. Now, one theme that has been emerging is the vulnerability of certain growth stories. When companies boost sales by financing customers, investing in counterparties, or otherwise creating demand through money they provide, they are pulling future risk forward. It can make today's numbers look amazing. But it can also create a fragile chain where one break causes many breaks, and when markets decide to focus on that fragility, capital rotates quickly. Now I want to give you my perspective on what to do without pretending I can predict every tick. First, don't confuse paper price with physical availability. Second, don't let volatility bully you into emotional decisions. Third, if you're interested in exposure, choose your lane. If your lane is physical, you need patience, price shopping, and a clear plan for storage. If your lane is paper, you need strict risk control, because margin changes and spikes can crush you. If your lane is miners, you need to be even more selective, because miners are businesses, not metal. A miner can have silver in the ground and still be a terrible investment if costs are high, debt is heavy, or cash flow is weak. So if you go that route, read the cash flow statement, look at all-in sustaining costs, and stop buying names just because they contain the word silver. I promised you the community extras, so let me add them smoothly. Now back to silver, because March still isn't letting go. The delivery tension is not just a spreadsheet problem, it's a behavior problem. If buyers fear a delay, they ask earlier. If they ask earlier, they drain registered. If registered falls, the fear grows, and that loop can feed itself. That's why I'm watching the next few weeks like a hawk. Now I want you to picture another chart. On one line, you have registered inventory slowly stepping down, then suddenly stepping down faster. On another line, you have potential delivery interests that can surge in a major month. Where those lines collide, drama happens. Either supply appears and calms the market, or price rises and rations demand, or rules shift and credibility gets questioned. Any of those outcomes can move silver. Now, because this is YouTube, people always ask, is this manipulation? Here is my answer. There are always large players with incentives, and there are always strategies designed to exploit leverage. But even if you believe everything is manipulated, the physical market still has to obey physics. An ounce that isn't available cannot be conjured by a headline, so focus on what can't be faked. Availability, premiums, delivery behavior, and inventory trends. Now I also want to ask you something, and I want you to answer it below. Do you think March becomes a genuine delivery stress point, or do you think the market escapes it with cash settlement and rule tweaks? And second, when you buy metals, do you care more about the spot price or about actually being able to obtain the metal on demand? Drop your answers. I read them. Also, a friendly request. If any of you have had a real financial win, big or small, share it in the comments. Your success can motivate someone else. Even one sentence can help. Now I need to mention something important for the people who are truly following this channel. By the time you're watching this, a members-only video will already be live, bundling the latest updates in one place, with more in-depth analysis and context. If you want the premium breakdown and you want to support the mission, join the membership. It also helps me see who is genuinely locked in. Now let's close the loop. We started with Switzerland because it's a real-world signal. We moved through volatility because it explains why paper can crash, even when physical is tight. We looked at deliveries and inventory because that's where March becomes the focal point, and we zoomed out to macro liquidity because it influences the timing of rotations into hard assets. Here's what I'm watching next. I'm watching whether physical premiums stay stubbornly high, even when paper sells off. I'm watching whether registered inventory continues to drop. I'm watching whether open interest shifts in a way that suggests buyers are pulling deliveries forward. And I'm watching the behavior of large players and options, because volatility hedges often precede big moves. If these signals keep aligning, then the question stops being, what is the spot price? The question becomes, can you actually get it? And when that question shows up in public, the market's tone changes fast. My name is John Agg. If this helped you, hit like, subscribe and hit the bell so you don't miss the next update, because the next few weeks could be explosive. And remember my favor, comment urgenag so the algorithm recognizes you're supporting original work, not recycled content. Bye bye for now.